Hey everyone, happy Monday. I'm here to talk to you about new builds today, and I have a special guest with me, and I will bring her in as soon as I give you my quick update on what's been going on. So if you've been watching every week, we've been updating you on our neighbor's construction process and our progress, and now it's a little harder to see progress just because everything on the outside is done. Things on the inside are what's happening. This morning I heard drywall screw, which is confusing to me because all the drywall was actually taken away. The scraps were taken away a couple weeks ago. I'm guessing they're at the stage. I saw a plumber out there. They're doing all the mechanical stuff. They should have been done if they've got drywall in, so they may be doing some plumbing in the basement. Looks like they might be finishing the basement. We saw a bunch of wood get dropped off for that. So typically once the drywall is up, then the taping and the texturing happens, and shortly after the kitchen cabinets get delivered. So haven't seen that happen yet, but I'm guessing they're probably going to be moving in the next 2 months. So when you're getting to this stage, you're getting very close to the end. So today I'm going to talk to you guys all about mortgages and what happens with a new build mortgage. So I have with me Stacey Petruch, and welcome, Stacey.
Thanks for having me.
Yeah, you're welcome. So we're going to talk today about new build mortgages. So when someone is looking to build a home, not necessarily, because spec homes, I think if possession is less than a certain amount, you guys can hold that rate that everybody loves right now. But at what stage does the interest rate change? Like how long of a period can you hold that interest rate for?
So that rate is good for 120 days, so 4 months.
Okay, so if a house is, so there are opportunities for you, like there are spec homes that are already built that you could still use that mortgage for. So it's still usable for new build. It's just, if you're building a home, it's not going to be 4 months. It's going to be 8 to 10 months, maybe a year to get your house. How does mortgages work for that? And how do you pre-qualify people? How do they know when they can remove the financial condition if, let's say, they're going to have to sell a house too?
Sure. So if you have two options for a build, one is the draw mortgage. So it depends on the lender and the builder if they want to be paid throughout the course of the build. So in that case, you have 6 months from your original approval for the builder to do what's called the first draw. And at that time, then your rate is fixed on that first draw. The other option is the completion mortgage. So essentially you would get approved right now, get a rate locked in, but really you're looking at 6 to 12 months, like you said, and their interest rates are quite a bit higher. Now, to get around that, what you can do is look at lenders once you're 4 months out from your possession date and lock in the lower rate at that time.
Right. So with a draw mortgage, it's just little small portions that come out, right? They don't take the whole mortgage amount of them. How many draws are there usually in a draw mortgage?
So there's 4 draws typically.
Okay.
Yep.
And so the 4 draws, does the interest rate change every single time? So like, let's say they get the first draw today, then in the next draw, is it going to be the interest rate of that time, or is it still the same as what you first got?
Yeah, the interest rate is locked in on the very first draw.
Okay, so that's a reason why a buyer would want it if they wanted to lock that rate, if they thought rates would go higher.
Yeah, exactly. Yeah.
Now, the thing to be noting is not every builder does draw mortgages. They do like draw mortgages because the smaller the builder I find, the more they like the draw mortgages because they don't have to then finance that build until completion.
Right.
And some of them insist that you do draw mortgage only. Now, I know from hearing about stuff, not every lender does draw mortgages anymore, right? Like
no, it's only a few lenders that do. Yeah, it's very small now. It's a very small.
TD used to do it and they don't do it anymore.
Sorry?
TD used to do draw mortgages, but they don't anymore, right?
Not that I'm aware of.
Yeah. So they've changed. So you have limited options now with draw mortgages. The larger builders tend to be okay with completion mortgages. I personally went for a completion mortgage because you start paying. So the interest you start paying on the first draw, actually you don't pay, like the builder I think pays for the interest, right?
Depends on the builder.
Oh.
So depending on the builder, some builders will cover the cost of the interest through the course of the build, and some clients, some builders, the clients are responsible for that. So
right, so that can make your decision.
It can add up. It can be, $5,000 to $6,000 in interest or more, depending on the purchase price.
Right. So it might not make sense to do a draw mortgage, even though you get that supposed lower interest rate.
Right.
And then a completion mortgage is just like a traditional mortgage where you don't get that mortgage doesn't start till you get keys to the house.
Right. Possession date. Yeah.
Now, how does it work for, like, with completion, you got to bring your down payment in before, right, to the lawyers. But with a draw mortgage, do you have to bring that down payment at the very beginning then before the first draw?
Well, the lender typically wants to see that you have that down payment available.
Mm-hmm.
But it's, again, you pay your deposit like you would with the builder. It really depends on the builder, what the builder wants to see. But typically it's when you, at possession, at closing, when that house is ready.
Here's a question. A lot of people, like a lot of builders we work with, is 5% down on condition removal, right?
Yes.
So that's fun. But what if you wanted to do, let's say, 15% down? That's an extra 10%. So if you did a completion mortgage, you would bring that 10% kind of closer to possession. You could. Some builders I know want that money closer. They don't want all that money at the very end.
Right.
How would that work for a draw mortgage? Could you like dump extra money? Like, let's say before the second draw, you got a big tax refund and you want to put it towards your mortgage. Like, could you do that, or how does that work?
Typically with the draw mortgage, they don't want to see any changes made to that mortgage after the first draw. Like you sign everything at the lawyers before the first draw.
Okay, so you're going to lawyers quite early on.
You are.
Okay, that's good to know.
Where's the
now,
completion?
Pardon?
Sorry, I was just going to say for the completion mortgage, if you have to sell your house, you have that longer time frame to sell your house, and you don't provide your down payment outside of the deposit to the builder until possession date at the lawyer's office.
Right. Okay, so here's the question, because selling your house is a very common thing you have to do, but during the condition period, most builders want an unconditional mortgage approval.
Right.
So how does that work? Tell me, like, if somebody, there's going to be a couple circumstances. One, you can build and approve for the mortgage without selling your home, but obviously you want to. The other scenario is, in order to approve for the mortgage, you have to sell your home. So how does that work for the approval side on your end?
Well, typically it's up to you to sell the house. I don't want to say you can remove conditions knowing that you have to sell the house, but.
Yeah. But you guys can't write an unconditional letter unless the house was sold, if that was the case. Right? Like if someone has to sell the house in order to be approved for the mortgage, in order for you to get an unconditional letter, that means the house has to be sold.
Right.
Right? Because basically you're saying you're approved, but you have to sell your house.
Right.
So conditional approval. And I know that like certain builders, like Pacesetter, they want an unconditional approval. So I've had some clients actually sell their home prior to even starting the process, just so that they could get that peace of mind. And that was back when the houses were a lot harder to sell. Clearly right now the market's changed quite a bit, and so chances of selling are a lot higher typically, but you need to talk to me because I don't want to say like condos, if you're in a condo and you need to sell, like that's a whole nother story. But you can potentially approve for both mortgages, right? Oh,
absolutely. A lot of time, if even though you aren't selling your house, you want to sell your house, we can get it approved saying that house is going to be a rental property. So maybe, what happens if you want to sell it, but it doesn't sell? We can use rental income to offset that property. So you're going to rent it out if it doesn't sell. The other option is bringing, you don't want to bring on a co-signer, but if you want to make sure that you can get approved without selling that house, you can bring on a co-signer. If the house sells in the time between now and possession, take the co-signer off and they don't have any ties to the mortgage.
Okay, so there's always options. Of course, I just thought interesting for people to know, because if they're watching this and they're looking at, hey, I want to build, mortgage is so different. And the other thing too is people think, I own a home that's worth $450,000. I must be able to buy a house if I want to downsize to like $425,000.
Right.
But that doesn't necessarily be true, right? Unless you're buying it all cash.
Yeah, things change, especially with COVID. Like things change. Your income may have gone down. The qualifying rate 5 years ago, like coming up to October, 5 years ago from October 2016, the qualifying rate was your interest rate. Now we have the stress test that the government put in, and the qualifying rate is 4.79%. So it can definitely, things have changed.
Because it definitely changed in terms of what you qualified for. Because it was easy to qualify 5 years ago, and now it's not impossible, but it's just definitely a little bit more tricky. A lot more paperwork.
Yeah, definitely more paperwork.
Yeah. So if you guys have any questions, you're watching this video afterwards and you're thinking about building, comment down below. Stacey's happy to connect with you to talk about that, because it's important before you go show home shopping. By the way, PSA, you're supposed to bring me before you go show home shopping. But you want to talk to Stacey and make sure that you figure out what you're actually approved for. And if you do approve to hold both properties, or if you approve just because you have to sell, and I'm happy to give you a value so you know what your house is worth instead of just guessing off of the city assessed value on what your house is worth to build your dream home. It's very important, because that can really wreck things in terms of, if we don't do this before you write the offer and then we give the stuff to Stacey, it's just a lot more stressful, because then you've already fallen in love with a certain house, and now it's like all this paperwork is needed and things are changing, and you might think, oh, I got 8 to 10 months to get my finances figured out because it takes that long to build, but that is very dangerous. We want to have your financing approved before. And I think you've probably seen this a lot with new builds too, is that once you get approved for a mortgage, I try to get my clients to put all their upgrades into the offer package so we can negotiate at that one time. But there's always people that add things after.
Yes.
So if you're approved for a mortgage up to 500, you spend 480, but then, and you got your conditions removed, and then you ended up adding an extra $5,000 because you have other little upgrades you forgot about. How does that work for their mortgage? It's still possible, right? As long as you're approved for that amount. Right.
Yes.
Have you ever seen it where people approve for 475, finish at 475, but then now they want to spend extra because of their upgrades? What happens there? Do they have to pay out of cash, or can they somehow get bumped up on their approval?
Well, you have two options, and that's with the completion mortgage. So when they get their possession letter from the builder, they also get a statement of adjustments, which confirms their final purchase price with all of their upgrades. So they have two options. One, they can get it approved. We send it to the lender and ask them to add the upgrades, and they sign a new commitment with the increased purchase price. Or two, they can pay the upgrades out of pocket.
Okay, so then they're not amortizing their upgrades if they don't want to.
Exactly, yeah.
Okay, awesome. Well, thanks for your time today. And guys, thanks so much for watching. If you have any other questions or want to know anything about mortgages and new builds, because that's a big part of building your house, then make sure you comment. Thanks for watching. Bye.